When you think about risk, do you just think about your investments? There's a lot more to it. In fact, we're going to talk about risk in a lot of different areas today. So enjoy this episode and always feel free to reach out to us. We'd be glad to chat with you.
We hope you've been enjoying all the episodes from the Secure Your Retirement podcast. If you'd like to keep learning and receiving these episodes, then hit the subscribe button and turn on notifications by hitting the bell so you receive alerts when each episode comes out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome, everyone, to Secure Your Retirement podcast. Today, we got a topic I think is really, really important. We talk a lot about risk management, and what we wanted to do today is talk a little bit about the expansion of that. Not do we want to break everything down into that, hey, we got to manage all this risk, but we kind of do. And so Merce and I were having a conversation, and one of the things that we get into conversations with people about is risk management. And when we say that word, a lot of times what people think is they just think investments. That's all they think about. We've talked about this. We believe that there are 5 critical areas to a successful retirement, and we call it the route to a successful retirement, ROUTE, and the R stands for risk. And so we are talking about risk, but yes, investments carry risk, and that is true. Markets are going to go up, markets are going to go down. We need to make sure that we've got a good portfolio to make sure that we can manage that. We talk about that all the time on this podcast. We talk about our 3-bucket strategy. We believe you should have a cash bucket, you should have an income safety bucket, and you should have a growth bucket. We're really good at helping our clients manage risk. So we talk to our clients about that investment risk, and we're actually saying, hey, that's something that we can manage. But there's other risks that we do talk about that sometimes people might not put it into the category of risk. So Merce, I know that we're not going to, this podcast is not about investment risk. This podcast is about all the other risk out there. So can you talk a little bit about, I know that you kind of have mentioned this a lot in different podcasts, but really this idea of around, I got to get income, and I need to have my income last, and how could that impact my overall plan?
Right. Yeah. So I think there's a major one that gets thrown around in our industry a lot that is what's called sequence of returns risk. And we've talked about this on our podcast before. It could be slightly related to the investment risk itself, but at the end of the day, in a nutshell, what sequence of returns risk is, well, first of all, it's something we do not want to ignore. But what it is when we walk into retirement and we're starting this withdrawal phase of life, the returns that we experience in the first few years are going to be very determinant in a way of the success of our plan. So I'll give you an example. If you walk into retirement and just imagine for a second, let's go back to say 2007. 2007, from 2002 to 2007, the markets were doing pretty good. Your dollars are pretty in a good spot at highs per se, and then you retire. And we walk into 2007, 2008 is when the end of 2007 going into 2008 is that big financial crisis that we had, and the markets crumbled for about 18 months. But you just retired and you need money to live off of. And so you're going to be withdrawing, unfortunately, while your assets are falling. And so when we have withdrawal on top of market loss for a significant period of time, it can snowball that withdrawal rate. It can snowball the pressure on the portfolio. And what the moral of the story here is it makes it very, very difficult to recover from that type of scenario. So sequence of returns risk is something that we want to be for sure be paying attention to and trying to alleviate some of that risk. Can you get rid of it altogether? You can't, but can you get your dollars somewhat compartmentalized so that we're not as exposed to unfavorable market conditions when we do walk into retirement and start needing to use that money. We've talked about the buckets quite a bit. Raiden just referenced it too. That's one of the ways that we avoid this type of risk. One that goes kind of hand in hand with it is our withdrawal strategy in general. So outside of the bucketing thing, or outside of the bucketing strategy, we also really need to be paying attention to what types of assets we have, where we're withdrawing from, and the taxation that's involved with them, and then fully incorporating that with our actual tax plan. So another example is maybe we don't think far ahead enough in the calendar year, and we are withdrawing from our IRA, right? We're withdrawing from our IRA and just building up that taxable income for the year, and then we also have maybe a stock scenario where we have to sell and we have a big capital gain that we weren't expecting, or maybe a mutual fund distributed a big capital gain, or you sell a house and you knew you were going to sell that house, but we didn't think about it as far as your withdrawal strategy. And you've got a massive capital gain that can completely wreck your tax return. So our withdrawal strategy, we want to be very much incorporated with what our tax year, our tax picture is going to look like. If we avoid withdrawal strategy, well, that becomes a tremendous risk as well. And that's something year over year that we believe we should be looking at. So kind of two blended together. One is around our sequence of returns. The other one's around the type of withdrawals that we can be making. And if we're not paying attention to both of those, we could run into issues. Another big one, though, Raiden, that you talk about quite a bit is around estate planning. And this can go in a lot of different areas, but what do you have there?
Well, I'm going to say risk number one is not having an estate plan. Okay. So that's the hugest risk. That's the biggest risk because if we find ourselves in that scenario, you basically are letting the court decide who's going to get money. But let's assume that you have an estate plan. One of the biggest things that we added to our overall services really last year, 2 years ago, was helping our clients set up their estate plan, and we made it a part of our overall service. Now, there's different things to think about, though, when it comes to estate planning risk. I always have this conversation with people, and I say, let's just assume that I'm talking to a married couple. And I say, how do you have your estate plan set up? And they say, well, if something happens to me, it goes to my spouse, and vice versa, meaning we're both our primary beneficiaries. That's very common, right? All right, so there's a couple things that we're going to talk about on that, but let's go number one. Who is your next in line? Well, they say, yep, this is the way this works. If something happens to me, it goes to my spouse. When something happens to my spouse, it goes to my children. So let's talk a little bit about what that risk could be. Most of the time, clients set that up where that it just puts them as the beneficiary, which means those children, if they were to inherit this money, are going to, or when they inherit this money, are going to get it lump sum. So what are some problems that we need to think about when we think about risk management? Well, let's think about a couple. One, what if they get this money, they inherit it, and they find themselves at this point, they happen to have had some type of an accident, or they find themselves in some type of a lawsuit. If we let this money go to them lump sum, it now opens it up and could expose it to that lawsuit. And that could be very, very difficult. What about this? What if I am leaving this money to my child and it's not done properly? And let's say that they are in the midst of either considering or already in the midst of a divorce. Could it open those assets up? If it's received incorrectly, absolutely. So when I say this, I always kind of think it's funny. I mean, almost every time I say this, I'm talking to somebody and they go, yep, I can see that happening. Or, yep, I don't like my in-laws, son-in-law or daughter-in-law. And I could definitely see that, and definitely don't want them getting half the money, right? I want to protect that so that it goes to my kids and then to my grandchildren if I've got grandchildren. So there are ways that we can set the estate plan up to be able to accommodate that. Let's talk about one more, and then we'll move into another risk. But here's another one. We talk about that normal couple scenario where I'm going to leave 100% to my spouse. So now let's assume that we've got an estate. I'm just going to use it, a $2 million estate. It makes it easy math for me. $1 million. And so we are a married couple, and we both feel that we have contributed and we are valued at half of the estate, right? Each of us own or possess a 50% ownership in this estate. So we say, okay, well, what happens if I pass away? So now my $1 million is going to become total to my surviving spouse. So now they have all $2 million. You say, no problem. I love my spouse. I want them to have that money. And then that money is going to move on down to the children. What if they get remarried? If they get remarried, are there provisions in the estate plan other than just the word of the surviving spouse that says your half of the estate could not go to the new spouse? You want it to go to your children. You're okay with your spouse using the money while they're alive, but you don't want half of it going to the new spouse, right? So there are provisions you can set up that put legal precedents in place that says when the the surviving spouse, if they get remarried, they can have legal uh, uh, documents that say that those half of the funds, your half, has to be able to go to the children at the death of your surviving spouse. Just things to think about, things that you might want to consider, things you might want to be aware of. But there is another one, and the other one is, what if you get sued? And that's really a liability risk. So, Merce, if you want to talk a little bit about that one.
Yeah, so liability risk, I think gets ignored a little bit from time to time. And the thing is if you're someone in that higher net worth category, I would in that category of being worth 1 to 15 million, you tend to get, I wouldn't say targeted, but these scenarios could become detrimental to you if you do get sued and you don't have proper protection. Yeah, a couple years ago, I was kind of reevaluating my auto and homeowners insurance and all this stuff, and I went with another program, and they added in for me to get a discount on the policies. They added in an umbrella policy, and a couple $100 for $1 million of coverage or something like that, right? Now, at the time, I did it just to get the discount, but today I'm very grateful that I do have it because I have I have a son, I own a house, and there, people come over to the house. If something was to happen to someone on my property, I could be exposed, right? So a lot of times our exposures are around auto accidents. If there's not enough insurance coverage, well, then you become you could become liable, or if there's a lawsuit involved, the dollars start to rack up on you. Property related incidents, right? If you have a pool and someone gets hurt at your pool or in your house, or you've got people working in the house and they get hurt, you could be exposed. And then other types of personal liability claims can be all mitigated by umbrella insurance, but not just insurance. You may want to think about, there's plenty of you out there that have plenty more than one property, and you've got rental properties, and maybe they're all flowing through your name. Well, the question could be, does that make sense? And maybe we need some type of entity that could protect us a little bit better, like an LLC or some type of other legal structuring. So asset titling, legal structure, umbrella policies, these are all things that are rather inexpensive, but they can protect you, and hopefully you never have to use them. And the cost that comes with them, you're not going to really worry about. But if you have to use them, you'll want something like this in place, especially when it comes to the umbrella insurance. So it's a one that gets, I think, ignored, but it's not one, that it's one that could really create a lot of issues if we don't have proper coverage and protection there. So there's some other ones out there though. People are living longer and longer, right, Raiden? So what about longevity?
Yeah, I'm gonna lump in a couple of risks here together. Longevity risk, which means I'm gonna live a long time, and then healthcare, right? So both of those things kind of come into play, because if I have to look at it. Sometimes we'll sit with people and we run our plans to age 90 as a default. And then I'll have some people who will sit in those meetings and they'll go, I'm never going to live to 90. And I got other people going, hey, I got a mom that lived to 100. In fact, we got a client right now. His mom just passed away 3 days shy of 101. And so there are people today, more and more, living past 90. And so we have to make sure that we've got a plan that can sustain a long life. Now, the other part that's really connected to that is sometimes I live a long time, but those last 5 years, say, of my life, I'm going to not only have the fact that I'm living long and having those expenses, but I could be in a long-term care facility. And so long-term care is really something that we need to think about. I could have nursing home care. I could have assisted living. And I really have that 3 to 5 year stint. And the reason why that's a risk is we're talking about, $100,000 to $150,000 a year to live in that type of scenario. And so we have to say, well, do I have that built in? Do I have something to help me be able to offset that risk? And we just think that's really important to have that discussion. And we've got a multiple of scenarios to help people think through living a long life, good, also how to deal with that long-term care scenario and not doing it with the old traditional long-term care insurance. And we can look at those tools that we have to mitigate that risk. So, Merce, let's handle one more here that I think's a top of mind for everybody right now, and that's inflation.
Yeah, rather relevant right now. Going back to long-term care, I say this all the time in front of families, is that today we feel more confident in the tools around long-term care planning than what was available 5 to 10 years ago. So it should be conversations that you're having around long-term care. But anyways, on to inflation. inflation is something we've been dealing with pretty heavily for the last 6 years now since the pandemic, and it seems like it's going to continue to be a problem. The dollars that you were spending 10 years ago are not buying what they were buying 10 years ago, and so inflation risk is a legitimate risk that we need to build into the financial plan, right? So when we're running our financial plans, we run inflation, right around 3%. So we account for it. And so we're theoretically giving raises every single year and stress testing the portfolio and stress testing the plan to make sure that with these raises every single year, while that's not truly going to be reality, can the plan sustain, and what's our risk around, running out of money or anything like that? So if we don't account for that, then we're going to have, gradual erosion of our spending power. A dollar today is not going to buy what 5 years from now, what that dollar buys today. And so we have to be planning for that type of thing. Especially, this ties back into longevity. People are living longer and longer. And so inflation continues to grow and snowball on us. And so, what we like about the bucketing strategy is that we've got a safety side that's there for our cash flow, but then we've got our growth side that truly becomes a long-term investment to offset a lot of that inflationary risk. We get better growth on that side, but we're not as worried because we've got our cash flow covered for a significant period of time. We could talk all day about inflationary risk, but that's the gist of it, and everyone is feeling it right now. So it's definitely something we don't want to ignore. So I know we went through a bunch of different types of risks. Raiden, why don't you bring us home?
Yeah, so basically, let's recap. We talk about risk management. Here's the things it includes: investment risk, income risk, tax planning, estate planning, liability, longevity, and healthcare. That was what we covered today. If you are listening to this and you're going, man, I didn't really think about the risk that way, I'd like to have a conversation, feel free to reach out to us. You can go to our website, pomwealth.net, go to the Contact Us page, fill the form out, and we'll be glad to have a conversation with you around any one of these risks or anything you want to talk about. We're always glad to have a conversation with you. As always, we thank you very much for listening. Have a great week. We'll talk to you again next Monday.
If you would like to find more information about Peace of Mind Wealth Management, we invite you to visit our website at pomwealth.net. If you go to the contact page and contact us, we'll send you a free copy of our book, The Peace of Mind Pathway. It lays out our process from beginning to end. Please visit our website.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.